Trend lines. Using trend lines. Trend lines are one of my favorite tools to use, and I think they tend to be pretty underappreciated. I connect trend lines to points of market structure, previous highs, lows, but there are other ways that people draw them, and that is fine. Trend lines can help identify when momentum is accelerating or slowing down and when it has reversed. This information is important as it can help you identify when you might want to take profit or when you might want to wait. This all depends on your strategy, but remember, we never truly know how long or how far a stock will run. So having frameworks set in place that gives you cues works to your advantage over the long run. I also draw lines to identify areas of consolidation so that it becomes easy to see when we are moving from transition to trend and vice versa. In essence, drawing a trend line for me is something that I can use consistently. It works. All markets have similar market structure as far as the way that they move, and so I can draw them the same way every time, and it helps me to be able to read the price action, and which allows me to execute consistently. So here we have the stock kind of in consolidation mode, definitely in consolidation mode, and then it breaks out higher from here, right? So the way that a trend line works for me is that you can't draw a new trend line until a new high or low has been made, depending on the not the distance, but the direction. So here, not until this here goes above here can you draw a trend line from here to here, and then it becomes extended. That's really all you need, right? Up to this point, the market continues to move higher. We talked about the 5 steps forward, 3 steps back. Well, sometimes it's more than 3 steps, but it didn't go as far back as it did forward. So this continues to move in the right direction. This is still a valid, still a valid trend. So here, once we get here and we're able to draw a new one, now we can watch how the market reacts with the trend line, right? So here, talk about the stock begins to lose momentum as it has a harder time maintaining the trend line, and it's also not making new highs, right? So we know that if the stock's not making new highs, that's a sign of weakness. Now we just have another visual representation of what's happening here. So as it starts to dip into it and dip deeper, this essentially is a consolidation here. I could have just as easily drawn a consolidation here as this transition broke down, but you get the point, right? Drawing this lets you know, hey, red flag, no new high, moving lower. Again, this downtrend line was not able to be drawn until we broke this low here, and it starts the transition, and then a new downtrend is formed. So, but again, I love it. I use it every day. I really do think it's one of the most underappreciated things. If there was one thing that I could have and I had to get rid of everything else, it would probably be this. All right, so another trend line example, right? So we talk about the trend and when it can be created. So technically, there could have been another trend line drawn here, but either way, what we see is consolidation, right? Consolidation doesn't necessarily invalidate the trend. So here, just for presentation purposes, this is the longer term trend, right? We can see the longer term trend is up. We're able to draw a new trend line here at this point here, and then we actually get what I like to call trend line acceleration. So stock gains momentum as a new steeper trend line is formed, right? When you start to get trend line acceleration, this, in my opinion, is where greed starts taking over control of the market. Again, we're going to go through all this stuff in more depth, but it's just something that I like to point out that I recognize. Oftentimes you can have up to 2 or 3 additional trend line acceleration points, and generally anything even beyond your typical 45-degree trend here is not really sustainable. So once we get up here, we know that it becomes more apparent that once a trend line is broken, after it becomes steeper and steeper, chances are it's not gonna regain that same momentum. So that's often a great spot to take profit or to exit the trade, as we'll discuss in the future. All right, exploiting trends to make money. So we are not here to try to time the market perfectly by picking tops and bottoms. We are here to let the assets we are watching show us where potential opportunity lies by identifying trends worth following. Our goal is to take advantage of that trend the best that we can, to take a large chunk out of the middle, the sweet meat, as my friend calls it, the easy money, right? Picking tops and picking bottoms is a fool's errand. It's not going to happen. You can get lucky every once in a while, but just like, the term catching a falling knife, it's just dangerous. It's unnecessary, right? We don't need that information we don't need to pick tops and bottoms to make money. So why do it to the detriment of ourselves? Let the trend establish itself. Once you see it, we'll make a plan for entry, what that looks like, and then you take advantage of it and you get out when your system tells you to. And it's as simple as that. All right, indicator warning. All indicators essentially display what the chart is already showing, but in a different way. A combination of momentum, price, and volume usually. Any advantages I have found are usually very inconsistent and therefore not worth incorporating. Most people, as I did, get caught up in believing that they can predict what will happen in the future, which, as I've mentioned, is impossible. Every single moment is unique and different than any other in the markets. There will never be the same players in the market buying or selling the same amounts at the same time, ever. It is always different. Indicators give the illusion of control, so my very strong advice is to just be careful. You can lose months and years trying to make them create a consistent profit, but it really is like an oasis in the desert. It's deceiving and imaginary. The study of price action allows us to read charts effectively, meaning we can anticipate where and why price is headed next. And this is where our focus should be. Using any indicators before learning this is like putting the cart before the horse, yet that's what most do. That being said, there are a few indicators and tools that I use and can make sense. Useful aspects. Identifying potential shifts in momentum are important, and though I have showed that using trend lines serve that purpose, there are a few indicators that do a decent job of identifying those shifts as well, such as the RSI, which is a relative strength indicator, the MACD, the moving average convergence divergence, and the EMA, the exponential moving averages. And just for a quick disclaimer, I don't use any of these, but I do see there's certain aspects in there that I can see that you could incorporate into a plan, but they are not a strategy within themselves. Like I know a MACD crossover, an RSI going from, below 20 and then higher, some people like to use that as an entry. Same thing for 80. In my opinion, it's just not worthwhile. We're not intended, nor do they function as being a trading system within themselves. But there are aspects that you can use, in my opinion, from a momentum aspect. Again, I like to use trend lines because I think they do a better job representing that, but everybody has their own preference. So again, just be careful, but I can see a potential use for these to incorporate if it's something that you like. So I just figured I'd go ahead and pick out a few to at least give you something to work with. If you're really dead set on having something, I can see a little bit of use for these guys. So a couple of the most important tools I use are market profile and VWAP because they help me identify value. Value is a very important concept we will go over in the next course, as well as breaking those indicators down. They are important because they do help me see and interpret something that I cannot see accurately on my own. Not because they tell me when I should buy or sell something, which is an important distinction. So we talk about indicators. You could technically say that a market profile, volume profile, and VWAP are indicators. Again, for me, I think that they're They're different, or you could call them, I guess you could call them value indicators. But they help me see and read price action and understand what the market is trying to tell me what it wants to do next. So in my opinion, that's completely different than relying on, an EMA, the 50-day EMA crossing the 20 EMA and, oh, that's a buy signal, right? Like that's completely missing the point in my opinion. And it's completely simplifying something that is impossible to simplify to that degree. There's too many other market variables. So anyways, like I said, we're gonna go over the market profile and VWAP and all those. And that's really, really cool. So I really kind of can't wait to dig in there and show you what I've come up with. I think for sure, I mean, those two things right there are worth the price of the course alone, because they took me forever to figure out. And once I could actually read them, it completely changed my trading.